There is a warning that Michael Burry issued in 2019 that most of the financial world chose to ignore. Not because the argument was weak, not because the data was absent, but because the conclusion was too uncomfortable to accept. Burry argued that the single most popular investment strategy in modern history, the strategy that millions of ordinary people were told was the safest path to retirement, was quietly building a catastrophic structural fragility inside the global financial system. Today, we examine exactly what Burry saw, why virtually no mainstream analyst took it seriously, and why the mechanism he identified has only grown larger and more dangerous in the years since he first sounded the alarm. Michael Burry is not a household name in the way that certain television personalities have made themselves famous by predicting everything and being accountable for nothing. Burry is something rarer and more dangerous to the financial establishment. A man who was precisely, verifiably, and profitably right at a moment when every institution on Wall Street was wrong. In 2005, Burry began reading mortgage loan prospectuses, the actual legal documents, page by page, and found something that no major bank, no rating agency, and no government regulator had bothered to look for. The loans inside these securities were structurally designed to fail. Burry bet against the entire American mortgage market. Every major counterparty told him he was delusional. In 2008, his fund generated returns of 489%, while the global financial system collapsed around him. That is the record of the man whose current analysis we are about to examine in full. To understand what Burry is warning about, you first need to understand how passive investing actually works at a mechanical level. When you purchase a share of an index fund, whether it is an S&P 500 fund, a total market fund, or any other passive vehicle, you are not making a judgment about individual companies. You are not evaluating earnings, management quality, competitive position, or valuation. You are purchasing a proportional slice of every company in the index, weighted by market capitalization. The larger a company's market value, the more of your money flows automatically into that company's stock. This is the core mechanic. Now consider what happens when billions of dollars pour into these vehicles every single month, as they have done for the last 15 years. More money flows into the largest companies, not because those companies have become more valuable in any fundamental sense, but simply because they are already the largest. Their stocks rise. Because their stocks rise, their market capitalization increases. Because their market capitalization increases, their weighting in the index increases. Because their weighting increases, even more money flows into them automatically next month. This is the loop that Burry identified. It is not investing. According to Burry, it is a mechanical feedback system that has been mistaken for a market. Burry's central thesis can be stated with precision. Passive investing, at sufficient scale, destroys price discovery. Price discovery is the fundamental process by which markets determine the real value of an asset. It requires active participants who study companies, form independent judgments, and buy or sell based on what they believe the intrinsic value actually is. This process is what creates rational prices. This process is what makes financial markets different from a simple popularity contest. When the majority of capital flowing through a market does so passively, following an index rather than evaluating fundamentals, that process breaks down. As Burry stated in his 2019 interview with Bloomberg, the theater is not that large, but everyone thinks they can get through the exit at the same time. What Burry means by this is that the size of the passive vehicle and the liquidity of the underlying assets are dangerously mismatched. And when the crowd finally moves to exit, the exit will not be large enough. The first dimension of Burry's analysis that demands serious examination is what analysts have come to call the liquidity illusion. Burry has written extensively about this concept in the context of the 2008 crisis. And he applied the same framework to index funds in his 2019 warning. The argument is as follows. An index fund appears to be a highly liquid instrument. You can buy it in the morning and sell it in the afternoon. It trades like a stock. Its price updates in real time. But the liquidity of the fund is not determined by the fund itself. It is determined by the liquidity of every individual stock held inside it, particularly the smallest and least traded ones. Burry's research pointed to a critical asymmetry. The largest index funds hold hundreds or even thousands of individual stocks. Many of those stocks, particularly the smaller cap components, have daily trading volumes that are a tiny fraction of the fund's total assets. Under normal conditions, this asymmetry is invisible. The fund flows smoothly. Prices move in orderly directions. But Burry's experience with mortgage-backed securities taught him a lesson that almost no one on Wall Street had fully absorbed. Under stressed conditions, when a critical mass of holders all attempt to exit simultaneously, the liquidity that appeared to be there simply is not. The theater fills with smoke, and the exit is a single narrow door. The second dimension of Burry's analysis concerns concentration risk at a level that most retail investors have never been made aware of. When most people buy an S&P 500 index fund, they believe they are diversified across 500 American companies. In theory, this is true. In practice, what Burry's framework reveals is something very different. Because the index is weighted by market capitalization, a significant portion of every dollar invested flows into a tiny number of mega-cap technology and technology-adjacent companies. By the early 2020s, the top 10 holdings of the S&P 500 accounted for more than 30% of the entire index. What this means in practice is that someone who believes they own 500 companies actually has nearly a third of their money concentrated in 10. The diversification that passive investing promises is, in Burry's framework, partially illusory. The investor who believes they are protected by breadth is, in significant part, running a concentrated bet on a handful of the most expensive companies in the history of capitalism. Burry has consistently argued that this valuation disconnect, stocks trading at extreme multiples not because of fundamental analysis but because of automatic capital flows, is precisely the kind of systemic distortion that precedes a violent correction. The third dimension of Burry's argument requires understanding a historical parallel that he drew explicitly. Before 2008, the collateralized debt obligation market had the same structural flaw that Burry now identifies in passive index funds. CDOs were complex instruments built from thousands of individual mortgage loans. They appeared diversified. They appeared liquid. The ratings agencies blessed them with AAA ratings. The banks packaged and sold them with confidence. But Burry, reading the actual loan-level data inside these instruments, discovered that the underlying assets did not support the narrative. When the underlying mortgages began defaulting, the model of continuous liquidity collapsed almost overnight. There were no buyers. Prices did not decline in an orderly fashion. They disappeared. According to Burry's public statements, the parallel to today's passive instruments is not metaphorical. It is structural. In both cases, you have a large, apparently safe, apparently liquid instrument that derives its apparent safety from assumptions about the underlying market that have never been stress-tested at the scale currently in operation. The fourth dimension is the feedback loop itself. What happens when the passive mechanism runs in reverse? Consider the dynamic in its outflow phase. A market shock occurs. Investors in passive funds, seeing their account balances decline, begin to redeem. The fund must sell its holdings to meet those redemptions. Because the fund must sell proportionally across all holdings, it sells both the liquid and the illiquid stocks simultaneously. This creates selling pressure on stocks that may have no fundamental reason to fall. They are falling simply because the index must be unwound mechanically. Other passive funds face similar redemptions and must sell the same stocks. Active managers, seeing prices fall, begin their own selling. The feedback loop that inflated prices on the way up now operates in reverse, and it operates faster. Burry described this dynamic in stark terms. The theater is filling with smoke. The difference between 2008 and a passive fund unwind, Burry has argued, is that at least in 2008, the risk was largely confined to professional investors and institutional balance sheets. The passive fund risk sits directly on the retirement accounts of tens of millions of ordinary people who have been told, repeatedly, that they are doing the right thing. Burry rarely prescribes specific actions to the general public. His communication comes in the form of warnings, not investment advice. But his methodology offers a framework of independent thinking that any investor can apply. The first principle embedded in Burry's approach is radical honesty about what you own. Before holding any investment vehicle, Burry would demand that the holder understand exactly what they own at the asset level, not the marketing description, not the fund name, the actual holdings, their individual liquidities, their actual valuations, and the specific exit mechanism under stressed market conditions. The second principle is what Burry calls modeling the exit. Every position, in Burry's framework, must be evaluated not on how it performs in a stable market, but on what happens when you need to exit, and everyone else needs to exit at the same time. If that scenario is catastrophic, the position carries more risk than its normal conditions behavior suggests. The third principle is the courage to act on your own analysis, even when every institution disagrees. In 2005, 2006, and 2007, every major institution on Wall Street told Burry he was wrong. He was not wrong. He was early. In Burry's philosophy, early and wrong look identical for a long time. Then the data resolves the question permanently. Today we examined Michael Burry's most significant standing warning that passive investing, at its current scale, has created a structural fragility in financial markets that most participants do not see and that most institutions have no incentive to acknowledge. We traced the mechanical logic of index fund capital flows, the breakdown of price discovery, the liquidity illusion hidden beneath the surface of instruments that feel safe, and the historical parallel Burry draws between today's passive vehicles and the mortgage instruments that collapsed in 2008. Burry's record demands that his warnings be taken seriously, even when, especially when, the mainstream consensus dismisses them. The question his work leaves every investor with is the same question he's been asking since 2005. Are you reading the documents? Are you modeling the exits? Are you thinking for yourself? According to Burry's philosophy, those questions are not optional. They are the entire difference between capital preserved and capital lost when the consensus finally breaks.